Hi, and welcome to the Financial Prophet. It's fantastic to see you here. You know, they say you never fight the Fed, but what if the Fed is behind the curve, and what if one of its voting board members gets fired for potential mortgage fraud? These are fascinating times we are living in. So, in today's Profit Report, we will discuss the state of the markets, the key events occurring this week, and how the Fed and other crucial elements can impact your investments, including your favorite stocks. Stocks experienced one heck of a rally on Friday. Things were pretty calm for the better part of the week, and we even witnessed some volatility increases while the Jackson Hole Symposium and other key events took shape. The S&P 500 even experienced 5 down days in a row before catching a considerable bid on Friday. Of course, it wasn't just the S&P 500, as the Nasdaq 100 ETF QQQ bounced by more than 1.5% on Friday, snapping a 6-day losing streak on Wall Street. So let's take a look at the QQQ ETF here. Still, while we've seen minor volatility increases, the pullbacks in major market averages have been insignificant as of late. In fact, the S&P 500 fell by only 2.3%, and the Nasdaq 100 by roughly 4.6% during the recent relatively shallow pullback process, which I can't really call a correction. Now, these are hardly corrections that could reset frothy valuations and offset overheated technical conditions. Therefore, the market may require a more considerable pullback or a consolidation process before stocks take off to new all-time highs again. Generally, in a base case scenario, a retracement to about 22,000 in the Nasdaq 100 futures may occur, which could translate to a pullback to roughly the $540 to $520 range in the QQQ ETF. And again, a base case pullback could take the S&P 500 to about the 6,100 to the 6,000 support level in future weeks. Well, some of you may be saying, what pullback? I mean, didn't the Fed just give us the green light to buy equities? Well, not so quick. While Fed Chair Powell did signal that he was willing to look past some potential inflation and focus more on the labor market, potentially opening the door more to a rate cut in September, a September rate cut may still not be a done deal. And again, I just want to reiterate this, that a September rate cut is still not guaranteed. The market liked what it heard on Friday, but there are still crucial data points and other elements to assess, and there's still considerable uncertainty in the near term. Let's look at the rate cut probabilities. The probability for a rate cut, it increased mildly from a week ago, but the probabilities don't signal a home run, so to say here. Also, there is still potential for substantial fluctuations in probabilities as the FOMC meeting remains about 3 weeks away. The Fed itself is not sure whether it will cut in September or hold off for another month. A lot will depend on the upcoming data. So we do have a very crucial data week ahead, so let's discuss it. This week will be absolutely critical for markets as there are many essential data points to assess that may increase or decrease the probabilities for a rate cut in September. And again, essential data points coming up this week include new homes data, durable goods orders, consumer confidence, Atlanta Fed GDP now, oil inventories, GDP, jobs data, and consumer sentiment, and of course, most importantly, the core PCE reading on Friday. In addition, we have Fed officials speaking throughout the week. The PCE will be monitored especially closely, and it may be more challenging for the Fed to justify a rate cut in September if the PCE comes in hotter than expected this week. Also, next week we will see the crucial non-farm payrolls report, which may be the most significant market-moving event. Also, I have to emphasize that last month's non-farm payrolls report was so poor that there's now growing concern that the slowdown may be worse than expected in the United States. The past 2 months' downward revisions were very substantial, signaling that the economy barely created any jobs in the last 3 months. Some key questions relative to the Fed also exist. For instance, what if this upcoming jobs number is better than expected? Will that now reduce the probabilities for a rate cut in September? Also, what if we get higher PCE, CPI, and PPI inflation while seeing job numbers better than expected? Would this dynamic reduce the rate cut probability to below 50% for September? I certainly think it's possible. On the other hand of the equation, what if the jobs number comes in much worse than expected? Yet again, yes, this could lock in a rate cut for September. However, at what point does the market say, the heck with this 25 basis point rate cut? I am really concerned about the labor market and the slowdown or a potential recession that may be ahead. So there is a very delicate balance here. The Fed must walk a fine line between inflation, the labor market, growth expectations, and other potential risks to the economy and markets in general. And I have to say that earnings are still very important here. And just to point your attention to this recent PDD report, about a 50% beat on earnings, absolutely huge. I mean, that's really impressive, and I have to say that China may be coming back here. The China slowdown is unlikely to last forever. Also, the thawing trade relations with the U.S. could be a significant net positive for the Chinese economy, as well as a catalyst for improving demand for Chinese companies' shares. However, let's focus on Nvidia, as it will report on Wednesday, and this may be the single most essential earnings report in this earnings season. Nvidia remains the undisputed AI hardware leader, and all eyes will be focused on Nvidia's results and guidance to gauge where the AI market goes next. There's been increasing talks of bubbles and even AI fatigue, and I understand this argument as AI has been, at the center. It's been primarily responsible for pushing many stocks higher and higher in recent years. In any case, all eyes will be on Nvidia to show that the AI rally still has steam. However, what if Nvidia's guidance is slightly worse than expected? Or what if it guides just not as great as the market has become accustomed to expect? What if Nvidia's margins dip more than expected? Essentially, Nvidia's stock is priced for perfection here, and expectations for Nvidia and the AI market in general, they remain sky high. In other words, the market may be looking for an excuse to take some profits here, and if there's even a hiccup in Nvidia's earnings, margins, or guidance, the broader AI market could slip and could potentially fall. On the flip side, if Nvidia reports better than expected results on most metrics, the push higher could continue. Nonetheless, I'm becoming more cautious on the AI segment in the near term here, as expectations have risen incredibly, and there's little room for disappointment. Now, in addition to Nvidia, we will receive earnings from Dell, Marvell, CrowdStrike, and other crucial companies this week. Just to clarify things, I'm not negative on stocks. I'm not negative on AI stocks by no means. I mean, I've been long the AI trade for years. I believe in AI, big time. But, I wouldn't be surprised if some of these AI stocks go through more significant corrections. We've seen, 10 to 20% pullbacks in many stocks like AMD, Palantir, even Nvidia took a little bit of a hit, and many other stocks that are related to AI. However, I could see that some stocks may pull back by 20 to 30% just to get some of that frothiness out of the air and, reset valuations a bit and get those technical conditions back in a more favorable technical image, basically. So I do think that we could continue seeing some more AI-related corrections in future weeks, especially if Nvidia and other sort of smaller AI bellwether stocks that are reporting this week disappoint the market. So the bottom line here is that while it's constructive that the Fed has adopted a more dovish stance toward future rate decreases, a September rate cut, while likely, it's still not guaranteed. The FOMC has not come to a consensus on lowering rates at the September meeting yet, in my view, as the Fed claims it likely remains data dependent, and there are still several key data points left between now and the upcoming FOMC event in several weeks. Meanwhile, Many valuations remain extremely stretched. Technical conditions are quite extended as well, and the sentiment may still turn more negative in the near term. This dynamic could potentially trigger an uptick in volatility in future weeks. We are also around a seasonally weak time for equities, as the August to November timeframe usually leads to healthy corrections, to take some froth out of valuations, normalize technical conditions, and set the market up for a year-end rally. Therefore, I still believe that the base case pullback to about 6,200 to 6,000 in the S&P 500 could occur and would be a very constructive dynamic for markets. Nonetheless, despite the potential for some transitory near-term turbulence, I remain bullish on markets in the intermediate and especially longer term, and I'm keeping my year-end S&P 500 target at 7,000. Thank you very much for watching my profit report. I genuinely hope that you enjoyed it, and more importantly, I hope that the knowledge you gain here helps you make more informed investment decisions in your future. I would also greatly appreciate hearing your comment. Please join the conversation in the comments section below. If you enjoyed my video, please click like, share, and subscribe to my channel so I can continue creating these highly informative and potentially very profitable videos for you. You can also join the Financial Profit, my exclusive investment community, which is seeking alpha's #1 service for proven portfolio profits. So don't hesitate to join our incredible investment community now. Thank you very much for watching. See you next time, and have an amazing day.